Welcome to Talk Tickers. You're tuning in for our concise breakdown of a crucial earnings call.
That's right.
Today, we're zeroing in on the Albertsons company, specifically their fourth quarter and full fiscal year 2024 earnings report.
A lot to cover there.
Exactly. Our mission, as always, is to distill those essential financial results, the strategic moves, and what they're projecting for the future.
Giving you the insights experienced investors need, without having to read that, whole lengthy transcript.
Let's jump right in. How did Q4 look? Sort of a snapshot.
Okay, so Q4, it showed, a blend of solid growth, but also, those strategic investments that are kind of impacting margins.
Okay.
Identical store sales, or ID sales, they were up 2.3%. That's pretty healthy.
Yeah, decent.
And their digital side really took off. Sales jumped 24%, and that was mostly driven by their own first-party platforms.
Wow, 24% is big for digital.
It really is. Adjusted EBITDA for the quarter landed at $855 million, which translates to an adjusted earnings per share, or EPS, of 46 cents.
Got it.
Now, interestingly, their gross margin, if you exclude fuel and LIFO, it came in at 27.4%.
So down slightly.
Yeah, a slight decrease, about 45 basis points compared to last year. They pointed to their pharmacy business growing, which has different margins, and also the costs tied to that big digital growth.
Makes sense. Any offsets?
They did mention some offset from productivity improvements, which helped a bit.
And selling and admin expenses.
Those, excluding fuel again, actually ticked down slightly. The rate was 25.7%.
Okay, so growth in key spots, digital especially, but keeping an eye on those margins because of the investments.
Exactly. That seems to be the theme. Growth, but investment impacting the immediate bottom line somewhat.
All right, let's zoom out a bit. The full fiscal year 2024, what were some highlights for the whole year?
Well, looking at the full year, they definitely kept investing in their stores, opened 11 new ones, and gave 127 existing stores a pretty significant remodel.
So investing in the physical footprint too.
Yeah, not just digital. And they stayed focused on returning cash to shareholders. They paid out $87 million in dividends just in Q4.
Okay.
Plus, they were buying back stock. They repurchased $83 million worth in the quarter.
Is that part of a bigger program?
It is. It's part of a $2 billion authorization, and they said there's still about $1.9 billion left on that.
So plenty of room for more buybacks.
Seems like it. And their debt levels look manageable. Net debt leverage was sitting at 1.9 times at year-end.
Okay, 1.9x. So balancing growth investment with shareholder returns and keeping debt in check.
That appears to be the strategy, yeah.
Now, a pretty significant part of this call was the leadership transition, right?
Absolutely. You had the outgoing CEO, VC Shanikaran, reflecting, and the incoming CEO, Susan Morris, laying out her vision.
What was the main message from Shanikaran?
He really looked back at navigating some major stuff, the pandemic, taking the company public through the IPO, and then this reemergence as a standalone company after that strategic review and the terminated merger.
Right, that was a big deal.
Huge. He really emphasized their customers for life strategy, said it was successful, and expressed a lot of confidence in Susan Morris to keep building on it.
And what does Susan Morris focus on? What are her priorities?
She laid out 5 key strategic priorities. Pretty clear roadmap.
Okay, where are they?
First, driving customer growth and engagement, really leaning into those digital connections. Second, growing their Albertsons Media Collective, that's AMC, their ad platform.
Okay, media is big these days for retailers.
Definitely. Third, enhancing the customer value proposition. So price, loyalty, own brands. Fourth, modernizing their capabilities, especially with technology. And fifth, driving what she called transformational productivity. Big savings goals there.
That sounds pretty comprehensive. Let's maybe dig into the digital piece a bit more. That 24% growth number really stands out.
It really does, and it's clearly a major thrust. They're putting significant investment into 4 sort of main digital pillars.
Okay, what are those?
First is e-commerce itself. We mentioned the 24% growth in Q4. It's now over 8% of their total grocery revenue. They definitely see more room to grow there.
Over 8%. That's getting substantial.
It is. Second is their loyalty program. Membership's up 15% year over year, now over 45 million members. They're talking about simplifying it, making rewards more immediate.
45 million members is a huge base.
Massive data potential there, right? Third is pharmacy and health. Revenue there was up 18% year over year. They noted it's currently a drag on margins, but these customers are apparently very valuable overall.
Interesting trade-off. And the fourth pillar?
The in-store mobile app. They said it has over 9 million users already. The goal is to make that whole shopping trip smoother, like real-time coupons helping you find stuff in the aisle.
Trying to connect the physical and digital.
Precisely.
You mentioned the Albertsons Media Collective, AMC. What's the ambition there? Sounds like more than just another revenue stream.
Yeah, they have pretty high hopes for it. The idea is not just to keep pace with the, booming retail media market, but actually to outpace it.
Outpace the market. That's ambitious.
It is. And they see it becoming a really major source of funds to reinvest back into the main grocery business.
Like a self-funding mechanism for other initiatives.
Kinda, yeah. I mean, you have to think, if they can capture even a small slice of the ad dollars flowing through their ecosystem, given their scale, it could be quite significant. But building the tech and attracting the advertisers, that's the challenge.
Right, execution is key. What are they doing on the customer value front? Competition's always fierce there.
Always. They're tackling it from a few angles. One is strategic price investments, basically, targeted price cuts in key areas to stay competitive.
Smart.
Another is beefing up the loyalty offers. They mentioned a cash-off option that's apparently quite popular, giving people that immediate reward feel.
People like instant gratification.
Don't we all? And the third big push is on their own brands, their private labels. They're aiming for those to make up 30% of their total sales.
30%. That's a common target we hear. Requires good quality, though.
Absolutely. They stressed focusing on both quality and price to make them a real alternative for shoppers.
Okay, shifting gears to operations. You mentioned productivity as a key priority. What's the plan there?
Yeah, this is a big one. They've set a really bold target. $1.5 billion in productivity savings over the next 3 fiscal years.
Wow, $1.5 billion. That's significant.
It's huge. The plan is to use those savings to reinvest in the business, like in digital and value, and also to help absorb some of those ongoing inflationary pressures.
So where are those savings coming from?
Several places. Things like moving more purchasing to a national level, getting better scale, consolidating some regional divisions they mentioned, combining Denver and Intermountain as an example to share best practices and cut overhead.
Streamlining the structure.
Right. Also optimizing how they manage their workforce, and then a major push on supply chain automation.
Automation seems key everywhere now.
It does. Their goal is to have 30% of their distribution center volume automated by the end of fiscal 2025.
30% by end of 25. That's fast.
It is. And they're also rolling out a new warehouse management system across the whole company by the end of this year. So really trying to use tech to make the background operations much more efficient.
Which hopefully helps offset some margin pressures from other areas.
That seems to be the calculus, yeah. Cushioning the impact of those digital and pharmacy investments.
They also touched on community support, didn't they?
They did. Mention that in 2024, the company and its foundation gave over $435 million in food and financial aid.
That's a substantial contribution.
Yeah, includes $40 million through their specific Nourishing Neighbors program. And they set a new goal, aiming to help provide 1.5 billion meals by 2030.
1.5 billion meals. Wow. Okay, let's look forward. What's the financial guidance for fiscal 2025?
Okay, first thing to note, fiscal 25 is a 53-week year for them, so that adds a little complexity.
Right, that extra week always skews comparisons a bit.
Exactly. So they're projecting identical sales growth between 1.5% and 2.5%. That assumes inflation stays relatively modest, around 1.5% to 2%.
Okay, 1.5 to 2.5% ID sales. And EBITDA?
Adjusted EBITDA is expected between $3.8 and $3.9 billion. That range includes about $65 million they expect from that 53rd week.
Got it. And earnings per share?
Adjusted EPS forecast is $2.03 to $2.16 per share. Again, about 3 cents of that is attributed to the extra week.
Okay. Any other key numbers for 25?
They expect the effective income tax rate to be somewhere between 23.5% and 24.5%. And capital expenditures, so investments in stores, tech, etc., are planned in the range of $1.7 to $1.9 billion.
So continued significant investment. What about beyond fiscal 25? Any hints about the longer term?
Yeah, they gave a sense of their sort of long-term financial model or algorithm. They're aiming for identical sales growth of 2% or more each year.
Okay, 2% plus.
And they expect EBITDA growth to actually be higher than that, starting in fiscal 26 and beyond.
So expecting leverage to improve over time.
That's the plan. And capital allocation priorities remain pretty consistent. Invest in the business first, keep paying and growing the dividend, and use that remaining $1.9 billion buyback authorization opportunistically over the next 3 years or so.
Makes sense. Did they give any color on the cadence of the year or potential headwinds?
They did caution that those investments we talked about, digital, AMC, health, pharmacy, customer value, They might continue to create some short-term margin headwinds.
Okay, so manage expectations near term.
Right. But they do expect grocery sales trends to gradually get better in the second half of fiscal 25. They also said they haven't really seen any big shifts in how consumers are behaving lately.
Still focused on value and promotions.
Seems so. Still looking for deals, stretching the budget. They also mentioned that while most of their products, over 90%, are sourced here in the U.S., they are keeping an eye on potential tariff impacts, mainly on ingredients that might be imported.
Always something to watch.
Yeah.
Any other points on timing or specific areas?
Yeah. They flagged that the timing of their big investments in 25 might not perfectly line up with when the benefits, like from AMC growth or productivity savings, fully kick in.
So a potential lag.
Exactly. Which could mean Q1 of 25 might look a bit softer as those investments ramp up before the full payoff.
That's helpful context. What about pharmacy customers or e-commerce profitability?
Interesting point on pharmacy customers. They tend to spend more across the board and become more engaged over like 1.5 to 2 years. They said a customer who shops both pharmacy and regular brick and mortar has a basket size that's 4 times larger.
4 times. That explains why they're investing there despite the margin dilution.
Right. High lifetime value. And on e-commerce, they expect profitability to improve as it scales up. Makes sense, leveraging the fixed costs better.
Did they mention GLP-1s? Those weight loss drugs seem to be impacting everything.
They did. Said it's contributing to pharmacy revenue growth, but importantly, their core script volume, just regular prescriptions, is also growing. And they see it as an opportunity. They think they can engage those GLP-1 users by offering foods and products that fit their changing dietary needs.
Turning a potential headwind into an opportunity. Clever. What about labor costs?
They expect wage pressures in 25 to be pretty similar to what they saw in 24, so still a factor, but maybe not accelerating drastically.
Okay. And any specific product categories doing well?
They mentioned center store, so your traditional grocery aisles, non-food items is seeing growth.
Good to see the core holding up.
Yeah.
And the division consolidation, like Denver Intermountain.
Yeah, the goal there is definitely productivity, but also finding best practices they can maybe roll out elsewhere, learning from the combination.
Okay, really trying to optimize the whole operation.
Seems like it, top to bottom.
All right, perfect time to transition. Let's do our This Is Not Financial Advice segment. Based on everything we've just unpacked from Albertson's call, what's an outrageous but plausible trade idea?
Okay, here's one. Playing off that huge digital push and the supply chain focus, Albertsons is aiming for 30% distribution automation by the end of 25, right?
Right. Ambitious goal.
So what if you looked at companies specializing in robotics and warehouse automation, specifically tailored for the grocery industry? Think automated picking systems, warehouse management software, optimized for perishables, that kind of thing.
Okay, so betting on the enablers of Albertson's strategy.
Exactly. If Albertsons hits its automation targets and other grocers follow suit, which they likely will to stay competitive, the demand for these specialized automation solutions could really surge. So a long position in a leading grocery automation tech company. It's a play on Albertsons' operational improvements driving demand in a related sector.
Interesting. Focusing on the tech suppliers benefiting from the trend Albertsons is pushing. I like it. Outrageous, but definitely plausible if that automation trend accelerates. Okay, another one.
How about this? Leaning into that 24% e-commerce growth and the whole customers for life digital connection strategy.
Go on.
Consider a long position in a company that provides sophisticated customer data platform, CDP, or personalization engine technology, especially one with proven success in retail or CPG.
The tech behind the personalized offers and loyalty.
Precisely. As Albertsons and frankly all retailers get more serious about leveraging their 45 million plus loyalty members and digital interactions, the need for powerful tools to analyze that data, segment customers, and deliver truly personalized offers in real time becomes paramount.
They mentioned investing in a real-time data platform for AI.
Exactly. So investing in a company that provides that underlying tech could be a way to ride the coattails of Albertsons and others' digital ambitions. It's a bet that the value is increasingly in understanding and activating customer data effectively.
Another good one. Betting on the software and data analytics layer needed to make their digital strategy actually work and deliver that personalized value. Outrageous, plausible. Okay, great ideas.
Remember, folks, just ideas, not recommendations.
Absolutely. So to quickly recap our deep dive into Albertsons earnings, We saw, pretty solid same-store sales, that really significant jump in digital, and a very clear strategic plan.
Yeah, focused on customer engagement, tech modernization, and those big productivity savings.
Right. They're clearly investing heavily, which might squeeze margins a bit in the near term, but the goal is obviously long-term growth, hitting those 2% plus ID sales and improving EBITDA targets down the line.
Mm-hmm.
What's the one thing you think investors should really keep the closest eye on in the next few quarters?
For me, it's the interplay between those productivity savings, especially the automation progress, and the margin impact of the digital, AMC, and pharmacy investments. Can they generate those savings fast enough to fuel the growth initiatives without margins taking too big of a hit?
Yeah, that balancing act seems crucial. Seeing if the savings machine can keep up with the investment engine.
Exactly. Successful executing on both is really key to hitting those longer-term financial goals they laid out.
Makes sense. Okay, that wraps up our look at Albertsons. Just a reminder, this conversation is for informational purposes only. It should definitely not be considered financial advice.
Please do your own research.
Join us next time on Talk Tickers, where we'll break down another key earnings report.